Hi, my name is Trevor Austin, founder of Authentic Life Financial Planning. In this video, we're diving into what is a tax projection. We're going to start talking about what you can do if you had a larger tax bill than you were expecting in 2024. Again, I think right now is a really great time to start the tax planning process because you just got your 2024 taxes completed, hopefully, or maybe at least have a draft of what it looks like, which means we can start making better decisions for 2025 so that you may not get hit with a surprise tax. And so one thing we'll be talking about is what you can do today to project your taxes for 2025, as well as what, once you know what it may look like, what you can do to have a smaller tax bill or less of a surprise tax bill in April of 2026. Now, there's really three options when you get hit by a surprise tax bill. The first option is you can adjust your W-2 withholding. So if you have a paycheck, you can adjust that withholding, which will allow you to have less of a surprise bill going forward. The second option is to pay quarterly estimated tax payments. That can be really good if you need some flexibility, or if you need, or if you just happen to be in a role where your income fluctuates rapidly or significantly. So if you have RSUs or bonuses or commissions that fluctuate based on the work that you do, paying quarterly estimated tax payments can be a much better option than adjusting the W-2 withholding. Really, the problem with W-2 withholding is that you have to go to your employer and update the W-4, and then they'll run that through their payroll system, and then you'll have your new tax withholding set up. And that may be correct, that may be enough for what you need to be doing, but even then, it may not be enough to really get you to where you need to go. There are W-4 tax calculators online, which certainly can help. But they're not perfect, right? And especially if you have highly variable income, such as, again, RSUs, commissions, large bonuses, or if you're planning to exercise stock options this year and you didn't in a previous year, paying quarterly estimated tax payments may be the better option. The third option really is to just do nothing. The positive with that is, you don't have to worry about that today. It becomes future use problem rather than today's use problems. But if you're here and watching this, that's probably not what you want to do, right? You likely want to take some sort of action so you don't have as big of a bill in 2026. And so let's talk through what a tax projection can look like and what you can do to build kind of a rough one. I want to take just a moment to talk about what I actually do before we get into my kind of rough tax projection that you can follow. So I use tax projection software and financial planning software to help me understand what is going on with my clients' finances. That allows me to create that chart that we saw earlier with the effective tax rate, that tax value that I was talking about. But I also use a tax projection software, tax planning software, that really allows me to get really specific on what could happen for our clients' taxes each year. And again, just allows us to make better decisions today so that they have less of a surprise bill come April. Now, if you're watching this, the problem is that you likely don't have access to that. It's not a cheap software. And if that's not your situation, then this rough tax projection, I think, is going to be a pretty good guesstimation of what your taxes could be. For this rough tax projection, as well as for how I project taxes for my clients, we have to start with what the income is. So you need to total up all your income from all the different sources, so wages, bonus, any equity awards, investment income, interest dividends, any other business income, whatever income you have, you need to total all of that up. And then you need to subtract out some things that are tax deductible. such as traditional 401k contributions. That does not include Roth, doesn't include after-tax contributions. It's only the traditional 401k contributions. Same as IRA contributions, it has to be a traditional IRA deductible contribution. It can't be a traditional IRA non-deductible IRA contribution or a Roth IRA contribution. Those are not deductible. But also health insurance, dental, vision, FSA, HSA contributions. All of those are things that reduce the amount of tax that you pay each year. And so you have to subtract those out. The next step is to subtract out the standard deduction or your prior year's itemized deductions if you itemize and expect to itemize again in the current year. We'll talk about that in a little bit more depth a little bit later, but essentially you need to reduce your taxable income by that so that you're projecting what your actual taxable income is accurately. And then once you've done that, once you've taken the total income, subtracted out deductions, subtracted out the standard or itemized deduction, you get to your total, which is effectively the taxable income you're expected to have in 2025. Once you've done that, you then multiply that by the brackets for federal, state, local, whatever applies to you, and then go from there. And that'll give you the total tax that you're expected to owe in 2025. Now, one thing I want to make clear is that this is a rough projection. It's not going to be perfectly accurate, but it at least will get you pretty close to where you should be for your taxable income and expected tax owed for the year. So let's look at an example. So the example I have here on the right basically follows this process. This top section here is the total income. So this client has some salary, it has some RSUs, and then they have some interest and dividends from investments that they own. That totals about $356,000. One thing I forgot to mention is that this person is single. They don't file married filing jointly. So just be aware of that as I go through the example. As you can see in the second step, we're going to subtract out 401k, HSA, any other insurance. This client is making maximum tax deferred 401k contributions, so traditional 401k contributions of $31,000. They are over 50, so they're making the full $31,000 contribution. They're also making the max HSA contribution of the $8,550 plus the $1,000 catch-up. Again, this client is over 55, so they're able to make that catch-up contribution. Finally, they have some insurance deductions, so health, dental, vision, FSA, if that applies, doesn't in this case. All of that is tax deductible on your return, so it reduces the amount of tax that you pay, reduces your taxable income. Finally, we need to subtract out the standard deduction. This client does not itemize, so they just use the standard deduction. In 2025, the standard deduction is $15,000. Once we subtract all that out, that means that they have about $297,000 of taxable income in 2025. Now that we went through and figured out what their taxable income is for the year, we can take a look at what the tax owed will be based on their bracket. And so on the left here, we have that same chart that we saw on the last slide where it shows the total income, the deductions, the standard deduction, and then total taxable income for the year. And then on the right, we have the single tax brackets, starting with the 10% going up to the 35% bracket, and how much tax is owed based on the amount of income that fits into that bracket. And so for this client, their $356,000 of total income results in about $73,000, almost $74,000 of just federal tax that he will owe in 2025. Now, this does not include state tax. That would be on top of it. Because there are so many states and so many, each state has its own rules. we're not going to go through a state example, but for me who lives in Minnesota, I would have to do this exact same thing with a Minnesota state bracket to figure out what my state tax owed would be. When it comes to Social Security and Medicare, we don't need to do this because this client is a W-2 employee. Their employer will calculate what the Social Security and Medicare taxes are for them, and so we don't need to do that. That being said, though, he likely would owe net investment income tax, which is essentially is an additional tax on investment income, so interests and dividends in this person's situation. And he also likely would be subject to the additional Medicare tax, which is a 0.9% surcharge on salary and RSUs bonus, basically any earned income that is above for a single. I believe it's 200,000 for couples. I believe it's married, filing, joint, I should say, is 250,000. So there are additional taxes that this client would owe on top, but for this example, I wanted to keep it kind of simple, even though this client would be subject to both of those taxes. So once we know what the total tax due is, we then can make a decision of, okay, should we adjust the withholding to increase it to kind of cover the amount that will be owed, or should we do quarterly estimated tax payments to kind of cover that difference? The way to kind of figure out what the difference is and how much you need to adjust your, again, either pay stub withholding or how much you need to pay in quarterly estimated payments is based on how much withholding you're already doing. And just projecting that out for the remainder of the year. And we'll look at a brief example in just a moment. Another way to do this, which is much easier than what I've already walked through and how I do it with my clients, is to just take what you owed in the previous year, divide that by your remaining pay stubs, and that will equal how much additional tax you should be withholding so that you can cover the difference between what you owed for 2024 and what is a closer estimate for 2025. Now, this estimate is going to be even, have a wider variance of accuracy. It just is not going to be as accurate as, going through the full tax projection as I walked through before with the rough one, or doing a full one with a financial planner or a CPA. It's just not going to be as accurate. But if your income is basically the same from one year to the next, if you don't have RSUs or commissions or any other kind of variable items in your income, it'll get you pretty close. And it's like that saying, horseshoes and hand grenades, right? It's going to be close enough. It'll get you pretty close to where you need to be. Let's look at a quick example of this. So what you need to do is take the prior year tax owed in 2024. That's going to be on the Fed at least. It's going to be on the 1040 line 37. So that's how much additional you had to pay in when filing your taxes. So as an example, if it's $10,000 is what was owed, and you're doing this in early April, and you can adjust your pay stubs starting in May. There's 16 remaining pay stubs left approximately. You would need to do the count for yourself to figure out what that is. But for someone who's gets paid twice monthly, rather than twice, once every 2 weeks, that's how many pay stubs would be remaining. And so for this client, it'd be increasing their withholding by $625 per paycheck. You would go through and do this exact same process with state if that applies to you. Again, just how much you owed in the prior year divided by how many remaining pay stubs, and that's what you would need to adjust to get your withholding a lot closer than what it would have been otherwise. As I said before, this option isn't going to be perfect. It's not going to be exact, but it at least will get you closer than what it would have been otherwise. And so we went through kind of a basic, kind of a rough tax projection, went through an easy projection. I don't do that for my clients. I do a full tax projection. And so just to kind of summarize that, for me, I build a full financial plan for my clients. We review the prior year tax return. We then project into the current year, and then we make decisions based on what is the best options for us in 2025. It requires a lot more work than the rough tax projection does, and it requires a lot more work than the easy tax projection does. But it gets us very close to what 2025 should look like and allows us ultimately to make better decisions so that we're paying less tax over my client's lifetime. Which is, again, that's ultimately the goal of tax planning, is to reduce the amount of tax paid over your lifetime. Thanks for watching. If you found this video helpful, please like, subscribe, and drop a comment below with any questions or topics that you would like to see covered. Financial planning is all about creating the life you want. Let's build it together.